Welcome to our halftime report. This is one of the more, I would say, anticipated events that we do every year. And because every year is different and there's always something to watch out for, or, in some cases be worried about, and sometimes in some cases be happy about. And I do think we have things to be happy about for the first half of the year so far. But this is definitely, I think, an interesting time to be watching what's going on, not just in the markets, but in the economy as a whole. And the headlines are really giving us whipsaw every single day. So, my goal today, as always, is going to be to help you get better informed. And actually, with this topic, because this topic is so near and dear to what I went to school for. I went to school for economics, and we're in this world every day. I mean, I could probably do this presentation just off the top of my head without any slides. But to keep things a little bit organized, to keep me from just rambling on, we've got a little bit of structure here. But what I want to go through is obviously what's gone on in the first half of the year and how that's informing what we're looking at for the second half of the year, both in terms of the markets and the economy, but also, and maybe this is even more important, giving you the framework that I tend to think about this through, or the lens that I view it through, and not like an ideological lens, like what school of economics, blah blah blah. Not that, but just what are the things that someone who's actually informed about the markets and the economy would be looking for to be better informed. And look, if you get through this presentation and you're like, that sounds great, Anthony. It sounds like you have a good handle on this. I don't know if I'm ever going to have a good handle on this. That's okay. That's why you work with us, so that somebody like me can have a good handle on it for you. But at least you're going to get a window into how I look at things. And this year, I'll move us forward a little bit. Again, most of you know me. I try not to assume that somebody this might be their very first time. My name is Anthony Gerbi, financial advisor with Stein Financial Group. Not only do I help clients and everybody invest their money and plan for retirement and all sorts of things, but I also, as we all do, watch the markets and the economy, and that really is where some of my expertise lies. So I'm going to try to interpret that today. I've been talking to people nonstop really all year, but especially since April when the tariff stuff kicked off. And it's been an evolving conversation, to say the least, with all the different news items. And that's what I'm going to hit on today. I'm going to hit on, yes, what the market's done so far, but how have tariffs, that's been the big news item from the first half of the year, or one of them. Secondly, and there's not a slide for this, but I will interject it, the passage of the Big Beautiful Bill, as it's called, the One Big Beautiful Bill Act, with literally the name of it. What does that mean for the markets, for the economy, and for you? And this will actually be a bigger piece that we'll be putting more together on as the year goes on, because there were a lot of future tax changes that were put in place with that bill that we all need to be aware of so that we can make the most or least of our taxes. But to get started here, and this is our agenda, um, this has been a very good 2025 has been a great example of I still need to figure out what, like, I need to coin a term for this, but I'm going to call it the coffee group problem. Okay. And coffee groups, I know there's still a thing that I think the pandemic killed a lot of them off and whatever. But how many times this year have I been in a meeting, Zoom, in person, whatever, and I get the point that someone brought up. And by the way, I'm not poo-pooing this. I'm just saying this is a common trend that I was talking to somebody, my friend, brother, cousin, nephew, whatever, and sister, and they were saying, "Ooh, I'm really worried about this," or "Have you heard about this? This is a big problem." Or sometimes it's the other end. Sometimes it's like, "Why are everybody should be doing this? This is a great opportunity." Blah blah blah. And I call it the coffee group problem because everybody's just looking for something to talk about at their coffee group, so they're throwing out opinions about the markets and the economy and whatever. And not that they're necessarily wrong. And I'm not saying, like, shut up, kooks. That's not what I'm saying. But what I'm saying is within those conversations, I have found that there's not really rigorous underpinning of what's actually going on, right? There's a lot of noise in those conversations, but how much signal is getting through. And my goal today is to get you at least set for that next coffee group that you're in. And so you can be able to say, well, here's what we actually should be looking at. If you're that type of person. Again, you might be a person who walks out of this and says, boy, I'm sure glad, Anthony, you know what's going on because this still doesn't make any sense to me. That's fine too, believe me. So let's get to the shape of the year so far. Now, this goes through the end of May because these numbers always lag, but essentially, in the June through so far in July time period, this graph on the right continues up, and let's see if I can do my hand right, up and to the right. So it's backwards for me, so I'm trying to adjust. It continues up and to the right. We've been doing very well as a stock market since really April 2nd when the tariffs were first announced. So first 3 months of the year through about March, fine. Things peaked in February. They dropped a little bit after February, but nothing crazy. On April 2nd, the White House announced the wide swath of tariffs on almost every country on earth at that point. And to differing degrees, of course, not all of them were as high as, say, China was at that time, but they announced sweeping tariffs. The market immediately dropped. And from this February 18th peak to the very bottom, which was on April 8th, it was about a 20% drop in the market. Now, I've got some statistics later on that'll kind of put that in context, but 20% is what we would call a bear market usually. It actually ended up being just under 20%, so that's why I don't think anyone is actually calling it a bear market, but for all intents and purposes, it hit 20%. So 20% drop in, call it 2 months, that is not like crazy, but it is significant. Like I would never say that that's not significant. And throughout that whole time period, especially once the tariffs were announced, we were kind of like, well, we got to see where this goes. To me, when the tariffs were announced, and I generally think that the way it ended up with this pause that I'll talk about in a second is the better way to do it. But when these tariffs were announced, the way I interpreted it was there was now a big flashing sign on top of the White House that said, phone lines are open, come make a deal. Right? That's what just throwing the tariffs out there meant. Everybody call up the White House, cut your deal, and we'll reduce these things. It's sort of a bargaining position. Now, I think the White House probably overplayed its hand there, not in terms of the negotiations, but in terms of the market reacted probably more strongly than they thought it would. So that leads to April 9th, where they announce a 90-day pause on the tariffs, and the market shoots right back up. And basically, it flopped around for a few weeks, but basically since then, it has been very good. The markets have, and you see, yeah, there's a U.S. and China deal back in May, and that's been worked on a little bit. Just yesterday there was a Japan deal that was announced. There's been deals that have been coming through. But one thing you should notice about this is 90 days from April 9th is July 9th. And it's July 23rd right now. And we, yes, are cutting deals, but what gives? I thought that was a 90-day pause. The tariffs are supposed to go back on. Well, back earlier this month, they punted the deadline to August 1st. And that seems to be what they're saying right now. They're going to stick to, for all we know, they may punt the deadline to sorry, not, I'd be surprised by December. I was going to say September 1st. They may punt again. And, as long as it takes to get some of these deals negotiated, I think is a good thing in the long run. Maybe, the least bad thing. Let's talk about tariffs for a minute. I've talked about mechanics of tariffs before, who pays and whatnot, but I want to actually talk about how they affected the market this year and what we're looking ahead with new tariffs or heightened tariffs or whatever. And all of this is caveated, and I've been using this example, even though it hasn't happened. So to be fair, it hasn't happened. But to me, one bad phone call with President Trump and Xi Jinping of China could lead to a different trade deal for China, right? I think there's always the risk of that happening. Not that I think it will happen, but just know that this is subject to change. And the change part of the equation is actually the most damaging part of tariffs. So it's one thing to throw out a number and say, this is what tariffs are going to be, and this is how we're going forward. And in a lot of cases, the market might react to that. They might react negatively because tariffs effectively are an increased cost, essentially. Now, I know there's revenue for it on the other side, but for the businesses, it's a cost. So you throw a tariff on, everybody reacts to it, and we all move on. It's a one-time deal. Yep, prices, maybe go up by whatever percentage they go up by, and we're done. The bigger problem with tariffs is when they're on again, off again, on twice as much, off less than they were. Like there's this flip-flopping all over the place. And the reason that can be so damaging, maybe not in the long run, but at least in the short run, is these businesses that are buying goods from overseas. The famous story, and I've told many people this, is about the week. So this week between April 2nd and April 9th, the CEOs of Walmart, Target, and Home Depot were at the White House talking about trade with the president. And they said, essentially, I'm paraphrasing, this is not a direct quote, but they said, if the tariffs keep changing, we're not going to be able to effectively buy stock for our stores because when we pick up the phone, it's all digitized now, but to be more dramatic about it, when we pick up the phone and call the factory in China and say, "Hey, we need X number of this by, uh, you know, September 1st," let's say, it's 3, 4 months because it's got to get on a ship, it's got to cross the ocean, it's got to get to the port in San Francisco, Seattle, Los Angeles, whatever. And that's when the tariff gets applied, not when we picked up the phone and called. So whatever it was today is the tariff. It's when it hits the port is when the tariff's applied. So if the tariffs are going to just jump all over the place and my costs could be 20% different between whether something hits a port on a Monday or a Wednesday, how am I supposed to buy inventory? How am I supposed to plan for that cost? It's just, I'm playing roulette here. And I think that message, among a few other things, and the market going down, did get through. This is my opinion. I'm not saying this is like a sourced opinion. My opinion is that messaging got through to the White House, and they said, okay, let's put a pause. Let's still negotiate the deals that we're trying to get. That was their goal, I think, all along. But let's just pause these tariffs and let our business community kind of gradually react to it rather than having to like go all over the place. So, tariffs, in a nutshell, yes, they tend to increase costs, but the real danger, at least of the tariffs that we had earlier this year, was the fact that they could change on a dime. We don't want that because that makes it really hard to budget if you're a company that does rely on buying things from overseas. And I know long term, the idea, well, maybe some of that manufacturing will come back here. Whether that happens or not is remains to be seen. Obviously, that's going to take years potentially to actually happen if it even does. But in the short term, which is what we're talking about today, essentially, it's better if we just have a consistent, this is what it is, we're moving on, than, hey, it's this today, that tomorrow, that sort of thing. So tariffs are not the only thing that has affected the markets this year. I don't want to oversell that, but they were the cause of the biggest volatility so far this year. So let me revisit. We do this halftime update twice a year. Actually, the one in February is called the State of the Markets, but it's essentially a halftime for the start of the year. Um, and at that time, one of the slides that they throw up on the screen here is what do all the big banks, the big investment firms think that the market is going to do for the year? Okay. And these were all the predictions from Morgan Stanley, JP Morgan, RBC, Bank of America, Deutsche Bank, Goldman Sachs. Where was the S&P 500 going to be at the end of the year? And the average was 6,600, which, by the way, I don't know. I have it pulled up, so I do know right now, but I don't ever track like, ooh, the S&P 500 hit 6,000 today, blah, blah, blah. I care the percentage increases or decreases. I don't look at what the points are. The points are just like, it's just a number. What we care about is the change from one day to another. So don't worry if you're like, I have no idea what the S&P 500's at. You don't need to track that. You do need to watch the returns at least, or somebody who's following it does. And so on May 30th, we were at 5,900, and it's like, okay, well, we've got a little ways to go. But I already told you that since the end of May, this graph has continued up and to the right direction, growth, essentially. So where are we today? And this isn't in the slideshow, I just have it pulled up because it's literally live. I'll refresh my page. As of right now, we are at 6337, 6,337. So what I will note is we're almost there to where a lot of these companies projected we would be at the end of the year. Now, you could take that one of two ways. You could say, oh, we're way ahead of schedule. That's kind of the way I'm taking it. Actually, this year has been better than what it has seemed like through the headlines thus far, even though we did in April have that drop that I already talked about. The other way to take it is, well, we're already kind of at what the projections are. So doesn't that mean it's going to be flat or maybe even, bounce around a lot from here? I'm less inclined to believe that part of it. One, you always take these projections with a grain of salt. I don't remember a single year where these banks have even gotten all that close to the end. So I don't want to oversell that they're like, they know what's going to happen or something. Nobody does. One thing I will point out is that back in April, all of those banks adjusted their projections down, except for like Wells Fargo and Morgan Stanley and UBS. And I don't know why they didn't. I don't know if that was just, well, we only put out our projections once a year, or if they're like, no, we genuinely don't think we should. But everybody who didn't adjust their projections is looking more right. Look at all these banks so that you can visually see it. JP Morgan got so pessimistic they thought the market was going to shrink this year by a ways. Now, the year's not over. I suppose there's still time for them to be right. I certainly hope they're not. But I also don't think they will be because again, all of these revisions down way too pessimistic. We've already recovered past all these points. So right now, Wells Fargo, Morgan Stanley, and UBS are looking like the smart people who didn't adjust their projections for whatever reason. Maybe it was an accident, but um, it's looking like this is going to end up being a good year. And without burying the lead too much, I've been talking about some factors here. Going forward, I am moving from cautiously optimistic for the second half of the year, which now we're already in July, to pretty close to just plain old optimistic, not even that cautious anymore. Not that we're not paying attention to things, I don't mean it that way, but like I say cautiously optimistic because I'm like, well, I think it could be good, but it still could be bad. And I'm more now like, well, we actually think it is going to be good. And yes, I could still be wrong. Nobody knows for sure. But we're even a little bit more confident that the second half of the year is going to look good. So I think the pessimism, and this goes back to that coffee group problem I talked about, the pessimism that erupted in April, and I get it, the tariffs did throw the markets off track, so there was reason to be pessimistic. But I think that was way overblown at that time. Certainly, we were telling people, hey, stick with it. If anything, this might be a buying opportunity for you. We did not feel like it would be a long-term downward trend, even though, yes, volatility would still be there. So I'm not trying to discount it. I'm just trying to give you the full context of what we're looking at. So for the second half of the year, what are we looking at? What are the risks? I have not talked about the big beautiful bill yet, and I promise I will. Maybe after this little section, I will. So this is what you're looking at. We call these speedometers, and they are backed up by data, but they're supposed to kind of just be, I would call it an economic vibe check. Where are the vibes right now? And it's more scientific than that, I promise. But at a glance, that's what you're supposed to glean from it. And this is actually from June of last year. So we're going to compare June of last year. Remember, last year was a good year for the market. So June of last year versus March of this year. Now, March because it's pre-tariff. Okay. And if I go back and forth, you know, some of them turned from yellow to green, some of them turned from green to yellow, but relatively similar. Things still looking pretty decent there, I would say. In June, now we've got a lot more yellow, right? And I won't go through all of these different topics unless somebody really wants me to, but I promise you'd get a little bored. I definitely could, but um, have things kind of shifted to more of a, well, let's see where this goes territory. Yeah, I think that's fair. And I think it's fair because the inflation has been or at least in June, because we got the June numbers a week or two ago, it was a little bit higher than the June the year before. Not crazy, not out of control by any means. And any headline that says, "Ooh, inflation's really a problem right now," inflation is not too bad right now. It is starting to rise, and that is something we need to watch for, but it's not really in a problem area, in my opinion. And of course, there's all sorts of different things. But what I will note here is despite the year that we've had so far, which again, if you look at the markets, actually looks pretty decent. But even if you look at the economy, which is what this is really supposed to measure, are things sort of mixed? Are there some good, some bad? Absolutely, there are. But is it all in the red right now? Like it would have been if we looked at this back in certainly the pandemic for those few months where it was really, we were all on lockdown, or even 2022, for example, where the markets were down in 2022. No, we're not even close to that. And this has underpinned one of the key messages I've been trying to get across this year, which is if you look at just the economic fundamentals, all the stuff that's on the screen, all the data that goes underneath these things, actually things don't look too bad. I'm not saying it's perfect. It's never perfect. And I would say we're a ways from perfect, but it's actually pretty decent out there right now. Unemployment is not crazy high. It's not seeming to grow like we would be worried about if we thought we were headed into a recession. Inflation has grown a little bit, but not a ton, and it's still in a range that is acceptable, I guess, in the short term anyway. And all of the other things that tend to impact the economy and the markets, you look at them and it's okay, that's okay. I'm not maybe thrilled about it all the time, but it's not something I'm like negative about either. So I think that's been one of the hidden things this year. In terms of the markets, the economy, the underlying fundamentals. If you just looked at this stuff every day and didn't look at any headlines, you'd say, okay, we're in a pretty decent spot. Like it could be better, but it could sure be a lot worse too. And I think the headlines have been so dramatic this year that it's caused not everybody, but a lot of people to say, "Oh my gosh, this really doesn't seem good." And I would say if you cut through that noise, it's actually a little better than you think, both market and economic. So let me, yeah, I think now is a good time. I don't necessarily want to wait till the end to talk about the big beautiful bill because, frankly, you'll be tired of hearing me talk by the end. And there's important information that I want to get through. So, Big Beautiful Bill Act just passed recently. It essentially, at its core, was an extension of the tax cuts that were put in place in 2017. I would argue that's its core. But of course, it's a very big bill. And so there's many different things. There's spending cuts that were factored in there. There's decreases in taxes, although I'll explain that in a second because it's a little bit different than just a flat decrease. Um, there's raising of the debt ceiling, which is something we did need to do. So I'm glad that passed. We don't have to worry about the government shutting down here anytime in the near future. And all sorts of other stuff is thrown. I mean, it is a big bill. And for me to sit up here, I'm not going to pretend that I know everything that's in the bill, because as we know, the people who wrote the bill don't know everything that's in the bill. I don't think there's probably a single person on planet Earth who knows everything that's in the bill. Maybe there's a couple, aides at the Capitol who are like, I've really got this on lock, but I would be surprised. That's just how our government works these days, I guess. But I do know some of the more impactful things. And the things that have worried people about it, as I've been talking to people, have been the deficit increases, right? The debt. And I don't think there's a slide in here that's going to specifically talk about debt. So let me talk about it here for a minute. Here, I'm going to make myself a little bigger because you don't necessarily need what's on the screen for what I'm talking about. It could help color it in a little bit, I guess. But so I'm going to start there with will this bill increase the debt and the deficit? Um, Almost certainly yes. Now, let me kind of give you some color around that first because I guess I would say that's not as bad as it might sound, or the headline might sound. They're like, I've seen the numbers where it's like $2 to $3 trillion more of debt on the books. First off, not to get way into the weeds, but let me first tell you the difference between the deficit and the debt because a lot of times the headlines kind of jumble those together and they do mean slightly different things. The deficit is our for one given year, usually, or any individual period, but usually we look at it as a year. Did we bring in more revenue or did we pay out more revenue? And therefore we had a deficit in our spending, right? You think of that just like you would for your own household. If you're spending more than you're making, you're using credit cards, which if you are, we should probably talk about that and find a way forward out of that. That's not a great place to be as a person, but as a country, a lot of countries run deficits. They spend more money than they take in through revenue, right? And I just told you that these were tax cuts, so now we're potentially decreasing revenue. It's not quite as simple as that, like a flat decrease, but we expect revenue potentially to decline. So that increases a year over year deficit. The debt is where all that deficit each year gets thrown on the pile. So the debt is the pile. The debt is every year we run a deficit, we rack up more debt, right? That's how we fund a deficit. Otherwise, where's the money coming from? It's coming from debt. And so they talk about the debt being, over it's the amount of debt we have as a country is bigger than the amount of value our economy creates in a single year. Now, not in 2 years or anything, and I'm not going to go into all those weeds unless, again, somebody's really interested. But that's where our debt is. So the debt is the big pile that gets added to every year. The deficit is just what the ledger looks like for any one given year. Okay, so the big beautiful bill cut taxes, but did it really? And it did, but let me explain. And I'll explain with a story first. So many of you know my wife and I, we live in Buffalo, Minnesota. My wife's originally from Buffalo. We moved there a few years ago, in 2023, actually. And we moved in the fall. And one of the first things that happened right after we moved was we got a letter in the mail, literally one of the first pieces of mail that was the school district saying, hey, there's a new bonding bill coming up for referendum this fall during election season. It was 2023 off year, whatever. And so we were like, well, okay. And we had our first daughter at that time. Now we have two. And we're like, hey, we want to support this. Like, that wasn't the issue. But what they said in the notification was, hey, did you know voting for this bonding bill isn't going to increase your taxes? And it was like, okay, tell me how that works now. And they said, well, what we're actually voting to do is to replace a bunch of debt that's falling off the books with new debt at the same amount. So your taxes will stay flat, right? You won't have to pay any more than you were already paying because some debt is falling off the books and we're just going to add more on at the same level. And I was like, okay, I guess that makes sense. The way I would describe the cuts that were just made is very similar. What actually happened was an extension of the tax cuts that have already been on the books since 2017. And yes, there are some new provisions and some new things that may cut taxes, so it does get more complicated. But it is not, and this is the thing that I think has been misunderstood, it is not a deeper cut by, at least in the regular tax brackets that we all pay. It is not a deeper cut than what was already on the books. So when you see the headlines of, yes, it's adding all this to the deficit and the debt, that probably is true. But that's because previous to this, we were using projections like these tax cuts would drop off at the end of the year. Now they've been made permanent. And whether that's a good or a bad thing, probably depends on how you feel about politics, firstly, but also depends on what actually ends up happening over these next, well, really any time into the future. Because, I'm not going to get into all the reasons why you would cut or raise taxes, but it's not quite as simple as cutting taxes equals exactly as much revenue as loss as you cut. There's other factors that come in. For all of you, what we need to know about this is two things. One, I do expect the debt and the deficit to increase. I think the numbers that have been thrown out there are probably very fair. I haven't independently verified them, but I think they're probably pretty fair. But secondly, for everybody on this call, and I know this because we've been learning a lot about this bill in these last few days, there are going to be tax opportunities next year that have not existed prior. There's going to be, and a lot of this doesn't take place till 2025, so I won't literally read off the list right now because we're going to have plenty of info coming out about the specific things. But there's going to be more benefit to giving to charity even than there was before. There's enhanced benefits for people who are over the age of 65. And by benefits, I mean potentially lower taxes or better deductions or better credits. That's where all this stuff falls into. There's lots of new opportunities for, hey, we could save a little bit on our taxes. So expect us to bring that up as we talk to you over the next, say, 6+ months into 2026, because that's when a lot of this takes effect. A lot of it doesn't take effect yet this year. So that, from a market standpoint, how that's going to affect things in the short term, I actually don't expect the big beautiful bill to affect the markets all that much in the short term. We actually have seen it thus far. The market kind of shrugged when the big beautiful bill was passed. It's like, okay, business as usual. And will there be consequences down the road? Well, yeah, there's always consequences to tax bills down the road. It's pretty hard to see exactly what they're going to be ahead of time, but there's always some consequences. But in the short term, I do not see, like, oh my gosh, all this future deficit money is going to cause a recession this year, for example, or even next year. I just don't see that happening. That's really not been the history of these kinds of bills. And I don't think it's going to happen now. That's an opinion. There's no guarantee that that won't happen, but I would be very surprised, is how I would put it. So I wanted to give a little bit of a background, and I guess to put a bow on what we're thinking about the big beautiful bill is opportunities as far as taxes, probably for everybody on this call in one way or another. Will it add to the debt and the deficit? Yes, it will. Is that good? In the short run, we can deal with it. In the long run, probably not good, but there's a lot to be seen there. And three, and the part I haven't mentioned yet, I've had a lot of people ask me about Social Security. What is this going to do to Social Security? Are we going to have to face cuts to Social Security? And every, 90 days, the headline gets recycled of, hey, did you know the Social Security fund is going to be insolvent by 2030 something? And that's real. It's on pace to be that. However, I would be extremely surprised if one, anyone who's currently receiving Social Security ever receives a cut. I would be shocked if that happened. Um, I would be just as shocked if anyone who is within, I'm going to say, at least 10 years, maybe up to 20 years from being able to receive Social Security. So anybody, let's say 42 and older, I would be very surprised if you get any cuts to your Social Security benefit. Could it happen? Yes. I would be shocked. And the reason I would be shocked is because despite these deficits that we've continued to have in this country, we've got the money to pay for it, or we've got the credit rating to pay for it. Now, that can't continue indefinitely, but if we need more money, we've got places to get it from. I won't go into my full example on debt that I usually give to people because it requires a whole other explanation. But suffice it to say, America is going to be okay, even with high levels of debt for the foreseeable future. Indefinitely into the future, that's where it can cause problems. But for the foreseeable future, I think we're okay, in my opinion. But will there have to be some changes to Social Security at some point? Yes, there will be. Because by that 2030, whatever it is this year, the year changes every year because money comes in, money goes out, blah, blah, blah. Will there have to be some changes to Social Security? Yes. Will they most likely be kick the can down the road a little bit further, stopgap solutions? I think so. Will that affect anybody currently receiving or about to receive benefits? I'm almost certain it won't. And the reason I'm fairly confident about all this is I think, and I've said this before, but when I think about politicians, and that's who would be making these changes, Congress would have to do this. The most reliable thing you can say about them, and this is nonpartisan, is they're going to act in their own self-interest. And self-interest by terms of what's going to get them reelected in the next term. And that's a theory that I believe in. And I think cutting Social Security benefits would be so damaging politically, at least for people who are receiving or on the cusp of receiving, that it would just be completely untenable to do politically. I think those people would get voted out of office, and it would be, I would be shocked if the political ambition to do that materialized, I guess is a way to put it. Now, what can we do to help Social Security, right? Well, we can do a lot of stuff for people who are under 18, potentially even, or not even born yet, to gradually kick that can down the road a little bit more. Raising minimum ages, getting rid of the full retirement age and just making that 70 years old. Raising payroll taxes to get more money into Social Security. Those are all options, and it might end up being a combination of like six or seven things that they end up doing. I don't know. Nobody knows what's going to happen, but I feel confident that something's going to happen because right now we're 10 plus years away from driving into a brick wall going 90 miles an hour. We're going to swerve the car one way or the other. Whether there's going to be this comprehensive, Social Security is fixed forever now, Bill. I'd be pretty surprised if that happens because that would be pretty extreme. But they're going to keep kicking the can down the road. So there's no guarantee of this. This is Congress. They can do whatever they want, essentially. But I think any major um, change, major disruption to the Social Security system would be met with so much resistance that it's just not going to be politically viable to even do it. So I tell people, don't worry so much about Social Security. I think that's going to be there. And that's what I've heard a lot of people worried about with the debt that's being added with the big beautiful bill is, well, we're already having trouble paying for Social Security. How's this going to help or hurt? I guess is what most people are worried about. Actually, I don't think this is going to hurt Social Security in the long run. Nobody knows for sure, and I'll be the first to say that, but I would be very surprised. So there's so much more that I could say about the big beautiful bill, but again, in a nutshell, I don't think it's going to really tank the markets in the short term or at least for the foreseeable future. It's going to add more debt. Is that good? Short run, it's neutral. Long run, probably not good. And then the cuts that are happening, will there be cuts? Yes. Will it be to Social Security? I'd be very surprised, is kind of my quick three takeaways. Okay, let me get back on track here. I'm going to skip that because corporate earnings is so boring to talk about that I can give you more entertaining things to hear about. Um, Inflation. I already alluded to this. Now, these numbers go through April. I have the June numbers for you. Right now, year over year, so how much did prices rise from last June 2024 to this June 2025 was 2.7%. So we're up a little bit from where we were in March and April. There, it was 2.4 and 2.3. Now it's 2.7. Worth watching if it goes up to 2.8, 2.9, or 3% for July, then we're going to say, okay, we've got a trend now. Right now, it's just a blip. In the future, it's a trend. Where this really matters is interest rates. Interest rates, and everybody has I'll come back to unemployment in a second. I want to get to my interest rate slide. Interest rates are determined by the Federal Reserve. And I have expected, and people sometimes disagree with this, but I have expected one interest rate cut this year, which is pretty modest. It's 0.25% is what we've expected. So really, you're going to be getting about the same rates on your mortgages if you did a new one. Your current mortgages will always stay the same, but new mortgages about the same, car loans about the same, maybe a little bit better. Savings accounts rates maybe a little bit lower, but still okay. But if inflation keeps going up, that's going to throw into doubt the ability of the Fed to cut interest rates because in a nutshell, if inflation's high, they raise interest rates to start bringing inflation down. That's what we dealt with in 2022. So if this blip of 2.7% inflation in June continues into July, I think they're going to have to seriously think about not cutting interest rates. What does that mean? Well, the market, I think right now has assumed that they're going to cut interest rates. So if they don't do it, that assumption that was baked in now has to be baked out, and the market could potentially drop a little bit. I don't think this will cause a super volatile time period, but it does have the potential to add to the volatility of the market. So that's why we're watching it. If inflation keeps ticking up, the market has the potential to be more volatile because interest rate policy will be, ooh, what do we do now? Sort of a place. There'll be more uncertainty there. And if nothing else, what you should know about the market does not like uncertainty, right? That is the number one thing it does not like. That's the whole problem with the tariffs when they're going back and forth. There's uncertainty. Um, this is maybe of the crazy charts that I'm throwing up on the screen, that I'm going way too fast over. This is maybe the one that I think is least, there is the least amount of public knowledge about. And that is our labor market, not just unemployment. So the light yellow line is unemployment rate. We're basically at about 4% unemployment. That is very low, historically speaking. So we're still in great shape unemployment wise. You can see visually that even going back, and this only goes back to 2016, we could go back 50 years and that number would still look good. So that looks good. And have there been layoffs places? Absolutely. People have been cutting costs, all that stuff. That has happened. I'm not trying to minimize that. But if you look at things in the aggregate, actually, we're in a great spot. The thing that is not well known is the orange line. The orange line is how many jobs are open in numbers of millions. So this is a very economics graph where they're tracking uh, thousands in thousands. 1,000,000 is a million. So really, when you see 7.3K, that means 7.3 million. Right now, there's about 7 million open jobs in this country, and there's only about 4 to 5 million job seekers right now. We have more open jobs in the United States than we do have people looking for jobs. Now, when people hear that for the first time, they always say, well, shouldn't that mean our unemployment rate is zero? Why don't they just take the jobs? And it's like, well, I could easily give you an example of why that wouldn't happen. Some of these open jobs are at low end jobs, jobs that if you're a career person who just got laid off, you're not necessarily going to jump at being a Starbucks barista. No offense to Starbucks baristas. Perfectly fine job. I'm just saying if you were working as in the corporate world, you're probably not going to jump to being a barista. You're going to look for another corporate job. And that might take some time to find. And your particular industry might have certain dynamics going on, blah, 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 blah. The point is, back in '08, which is not on this chart, so you'll have to just stick with me on this. Back in '08, when the Great Recession hit, there were not open jobs for people who got unemployed. There was the unemployment line. That was the only option. Right now, are people getting laid off in places? Yes. Do they have places to land if they do get laid off? Usually, yes. Will the jobs be as good? Not always, maybe not most of the time, but there will be something. And it makes a big difference for the economy to have someone who gets laid off go to another job, even if they're making less and it's not quite as good, than going straight to the unemployment line. Okay. That makes a big difference in the aggregate. So I'm not trying to be insensitive by talking about big numbers versus individual stories. Of course, there's all sorts of things happening right now. But when we're looking at where does the economy, where does the market go, actually, the labor market's in pretty good shape. And that's one of those things where I'm like, the headlines would tell you one thing, but the data would tell you another. So, headlines going forward, labor market's looking pretty good. Trade policy yet to be seen. You know, the August 1st is the new deadline. We'll see if they stick to that or if they punt on it again. AI, which, you know, if you have questions about that, I'm no AI expert, but I can at least speculate with the best of them about where AI is going to go. I don't think it's going to slow down at all. I think the companies that are invested in it will continue to invest, and it's going to be potentially the next 5 years plus are going to be dominated by it. But where that goes, it's like trying to sit here in 1990 and me telling you what the internet's going to be 10 years from then. Nobody had any idea. Not even the people who were making it knew what it was going to be. So we're just going to all have to react to that as things happen. So, um, what's coming up? And I promise I'm actually pretty close to done here. So you've been very patient with me so far. Um, the Federal Reserve puts out projections every year for what they think employment, inflation, and GDP, which is economic growth, is going to be. And these are all probabilities. So, you know, If you ever took a statistics class, this is your bell curve. You're probably going to fall somewhere in the middle of your bell curve. Well, right now, they think we're probably going to be between flat growth and 2.5% growth. This is as of May. I actually think it's going to be north of that for the year. I think we could end up getting closer to 3% growth for the year of 2025. Not for sure, but I would definitely take the higher end of that projection, 0 to 2.5. I would definitely take positive and I would definitely take the higher end as of right now. Unemployment, they think we're going to stay under 5%. I would say we're going to be closer to 4% between now and the end of the year. Again, this is just my opinion. I'm not saying I know this answer, but to give you a sense of where our heads are at in terms of optimism and all that. And inflation. They think so, and you can see current versus previous, they've revised these projections. These revisions to the idea that inflation is going to go over 4%, like that there's a good chance of that, I'd be pretty surprised by that. I would not be shocked if it goes back over 3%, but I think over 4%, that would be a pretty big jump. Certainly possible, but I think the tariff stuff would have to go really badly for that to end up happening, or something else crazy would have to happen. I talked about rates a little bit. One thing you should know, and this is another reason why rates are important, not just for the market, but for bonds. And pretty much all of you in here have bonds in your account. They're diversifiers. They're less aggressive than the stocks that you might own, and they help when the market's not doing as well. This year was a great example of that. Bonds really did help quite a bit this year while the market was going down. When bond interest rates, which is yield is another term for interest rates, essentially. When those go up, bonds tend to go down in value. And when they go down, bonds tend to go up in value. And one of the reasons that's important is I already talked to you about interest rates this year. We are, I would say still, unless numbers come in to change this, expecting one interest rate cut this year. What should that do to the bonds in your portfolios? It should make them this way more valuable. It should put the prices up. So that would be good potentially for us. Now, I'm not saying it's going to be like a life-changing gain in there, but we'll take it. We'll take some growth. So if that ends up not happening because of inflation, that could be not necessarily a negative, but just not as much positive as we hoped for. So that could undercut the growth that bonds have been receiving this year. Um, Stay focused on the fundamentals. This is bull and bear markets. I'm actually going to skip that. This is a really important graphic right here. And the question that it answers is simply, how often does the market go down within any given year, let's say? And the answer is, since 1928, how often does the market go down at some point during a year, or just forget about a year, just how often does it happen? A 3% drop. 3% drop is basically nothing. You can get that in one day these days because the markets are so high relative to history. That happens 7 times a year on average since 1928. So if you see a bad day in the market, it's like, oh, markets were down. They never tell you the percent, by the way. This is my pet peeve. They always tell you the Dow fell X number of points this today. You don't have to care about the points. I don't care about the points. You care about the percentage. That's what matters. And they never report that because the points always make it sound like it's a bigger number. So it gets everybody more freaked out. Things I would do, I would change if I were in charge. I would change that. But anyway, 3% dip, pretty normal, happens, about once every 45 to 60 days, essentially. Not anything to really worry about. A mild, I think that's a typo. It should be mild correction, not mild connection. That's weird. There must have been an autocorrect in there somewhere. A mild correction would be 5% or more. Well, that happens about 3 times a year. 3.5, call it. So again, pretty normal. 10%, 10% drop. That happens on average at least once a year. Now, again, average, not every year has it, but a 10% drop in the markets, which I would say 10% is the point at which unofficially that's kind of the freak out line where I start hearing people freaking out a little bit. Not pointing any fingers at anybody. I'm just saying, like, anecdotally, that might be the freak out line. That happens every year on average. That does not mean that the year is going to be bad. a 15% correction once every 2 years on average, and a 20% bear market once every 3.5 years. Well, did you know that 2024 and 2023 did not have anything above a 10% drop in them? That was the worst. 2024 had a 10% at one point, and then it recovered and it did great. This year we had our 20. Well, that's one out of every 3 years. So we're right on schedule for what's actually average for the markets. And I think that has really been lost. Of course, it always happens for a different reason. Of course, the headlines are always unique from one year to the next, totally. But we're not outside of what is considered normal for the markets to have gone down this year. Forget about the headlines. Just looking at the numbers. It's not crazy what actually happened in April, even though it felt like wow, things are really kind of unprecedented right now. If you just look at the numbers, they're not. They're actually well within normal bounds. And by the way, in almost all of these years, even with a drop in them, the market recovers and makes money for the year. And that's where we're at right now, by the way. The market is up for the year. I think with the last month, things have been really good, so people know that now. But people were surprised when they were coming in and we were looking at their statements in like May or June, and they're like, all right, how bad is it? Tell me what the damage is. And I'm like, well, I've got good news for you. You're actually up this year in your accounts. And if you're wondering if we haven't talked about where you're at specifically, please get in touch and I can help. And even if you're not like your account's not with us, like you're a deferred comp person and it's with Voya, I can give you exactly what my thoughts are on the account. No, you're up this year. I think most of you are going to be up. If you're not up, we should talk about that. But this year has been relatively, from if you look just at January 1st to today, it's been relatively good. And I think that surprises a lot of people, especially with, again, all that we went through in April. So I've hit the end of my slides here. I'm sure there could be a million questions that people could throw out. I'm gonna and please feel free to type them in or ask them. I'll stick around here for a little bit. Also, if you didn't know, all of our events as they're announced show up on the events tab in our website. So if you are looking for, hey, I must have missed the invite for this month. What are they talking about? Go to steinfinancialgroup.com. There's an events tab, and there's just one click of a button to register right through there. So, feel free to watch your email for them too. But if you're like, oh, I didn't hear anything this month, feel free to check there as well. I do see a question come through. The dollar. So the dollar relative to other currencies has shrunk as of late. Um, Quick thoughts on exchange rate between US dollar and euro or any other currencies given the US economy. If the Dow is up, does that really mean better for the USD? And thank you, Tim, for that question. So that has been a big trend this year. The dollar. The dollar has depreciated relative to foreign currencies this year. Uh, there's a lot of reasons for that. One of the big ones is the tariffs. And not necessarily the tariffs doing it themselves. I think that's a misnomer. I think a lot of the countries that got slapped with tariffs have sort of decided, whether they've fully decided or not, to say, we can't depend on the United States to, I guess, be I'm trying to think of the right term. We have to be more self-sufficient than dependent on the United States. And that can lead to them deciding how much of our debt they want to own. All the things that do impact currencies, that's what tends to impact currency, like how much US debt you're holding. And essentially, the US dollar has gotten a little bit less valuable around the world. For investors, that actually can work in our favor because if you invest in international companies and they earn money in, let's say, euros, that means they are they're reporting their earnings in euros, and euros are buying more and more dollars. So you're actually doing better on a dollar term. So international investments have done really well this year, partially because of the currency thing. So it's not as simple as, well, if the US has a good day in the markets, does the currency appreciate? No. It doesn't, it's not even as simple as if the US has a positive trade relationship with some country or we're earning so much money in tariffs or whatever, does the US dollar appreciate? No. What really matters is a whole number of things, but one of the things is the debt. How much debt does that other country own of the US's? Because you can use that debt even if you wanted to, like China did this for a long time, to peg your currency to the dollar. So we always want to be 20% cheaper than the dollar, blah, blah, blah. China did that for a long time. They haven't done it as much lately. But currencies float. They're like investments. There's a whole part of investing that invests in literal currencies and uses that as their investment. And for us, what we need to be in position for is that if there is a swing up or down in currency, that it's not dramatically affecting your account, at least on the negative side. We'll be happy to take advantage of it where we can, but we don't want to have that be a risk that then throws our whole plan off base. So that's what I focus on the most is how to take that currency risk off the table for you as an investor. That's the most important thing. Then, yeah, if we can take advantage of it, that's great. Yes, and I wish the comment just came in. I wish your crystal ball was even clearer. Yes, obviously I do too. I do want to leave you with a sense of optimism. I do have a sense of optimism right now, at least about the markets and the economy. That doesn't guarantee anything, and I try to be clear about that. But I actually do think the second half of this year will be better than the first half. And as it turned out, it didn't look like that in the beginning, but the first half ended up being pretty decent. So if that ends up happening, we could be in for a very good year. I don't want to oversell it because there's a lot of year left, but at least as of right now, I'm not seeing like a recession on the horizon or anything like that. Now, you know, most people don't see recessions coming. That's kind of the point. But, it's helpful to at least take stock of where we're at. All right, we're just past one. If there were any other questions, just email them to us or you can call in or however you want to get them to us is great. Thank you everybody for being here, and we will see you next month. Take care.